Imagine finding a stock trading at just $2.65 per share that analysts believe could reach $4, representing a potential 51% gain. But here's the really interesting part. This is a luxury hotel REIT that owns some of the most prestigious properties in America: Ritz-Carlton Resorts, Hilton Properties, and Marriott hotels in prime locations like Lake Tahoe, Sarasota, and Washington, D.C. A company paying a 7.5% annual dividend yield while you wait for potential appreciation. Now, I know what you're thinking. The hotel sector has been challenging, and this stock has been beaten down significantly. But here's what most investors are missing. The company just initiated a strategic sale process in August 2025, exploring alternatives including potentially selling the entire company. They've already sold multiple properties at attractive valuations, including the Marriott Seattle Waterfront and recently the Clancy for $115 million. Management is actively returning value to shareholders. The Q3 2025 results showed impressive momentum with their urban portfolio delivering 6% RevPAR growth year-over-year. Group bookings are up 14% year-to-date, and corporate demand is strengthening post-Labor Day. They've successfully refinanced all 2024 debt maturities and are addressing the sole 2025 maturity. With a hold rating from analysts and a price target of $4, about 51% above current levels, could this dividend-paying luxury hotel REIT be one of those contrarian plays that rewards patient income investors? But before I reveal which luxury hotel REIT I'm analyzing today, if you're new to smart investing, welcome. I specialize in finding undervalued dividend stocks, REITs, and turnaround opportunities that most investors are overlooking. I do the comprehensive fundamental analysis and research so you can make informed income investing decisions based on real data and emerging catalysts, not just market headlines. If you want to discover more high-yield opportunities like this, companies with real assets trading at beaten-down prices with solid dividend yields, make sure you hit that like button and subscribe to Smart Investing. New videos posted regularly covering the best dividend and value opportunities across all sectors. Now let me show you which luxury hotel REIT could be ready for a strategic catalyst. The company I'm talking about today is Braemar Hotels and Resorts Incorporated, trading on the New York Stock Exchange under the ticker symbol BCHR. Braemar is a real estate investment trust, REIT, focused on investing in high-revenue per available room luxury hotels and resorts across America. Founded in 2013 and headquartered in Dallas, Texas, Braemar operates under a very specific investment strategy. They only invest in hotels with RevPAR, revenue per available room, of at least twice the U.S. national average. For 2024, that meant targeting properties with RevPAR of $199 or higher. This focus on luxury keeps them in the premium segment of the hospitality market. As of September 2025, Braemar owned interests in 14 hotel properties across 6 states, the District of Columbia, Puerto Rico, and St. Thomas, U.S. Virgin Islands, totaling approximately 3,667 net rooms. Their portfolio includes iconic brands like Ritz-Carlton Lake Tahoe, Ritz-Carlton Sarasota, Capitol Hilton in Washington, D.C., multiple Marriott and Hilton properties. The company operates as a REIT, which means they must distribute at least 90% of taxable income to shareholders as dividends. Here's where Braemar becomes an interesting contrarian play for income investors. The company is in the middle of a strategic transformation that could unlock significant value. First, the strategic alternatives process initiated in August 2025 is huge. The company has engaged advisors to explore options including asset sales, portfolio optimization, strategic partnerships, or even a sale of the entire company. When REITs announce strategic review processes, it often leads to transactions at premiums to the current stock price. Second, they've been actively monetizing assets at attractive valuations. They sold the Hilton La Jolla Torrey Pines, the Marriott Seattle Waterfront, and most recently the Clancy Hotel for $115 million in November 2025. These sales demonstrate that their properties have real value, and they're using proceeds to pay down debt and return capital to shareholders. Third, the operating performance is improving. Q3 2025 showed their urban portfolio with 6% RevPAR growth year-over-year. Group revenue is up 14% year-to-date, and ancillary revenue per occupied room increased 8.3% compared to the prior year. Corporate demand strengthened post-Labor Day, indicating business travel is recovering. Fourth, they've cleaned up the balance sheet significantly. Management successfully addressed all 2024 debt maturities and extended the Ritz-Carlton Lake Tahoe mortgage in January 2025. The refinancing of 5 hotels in March 2025 improved their debt profile. The Q3 2025 results released in early November showed both challenges and progress. Revenue: $143.56 million for the quarter. Comparable hotel RevPAR: down 1.6% due primarily to renovation work at Ritz-Carlton Lake Tahoe. Key highlights: urban portfolio delivered 6% RevPAR growth, strong performance. Group bookings up 14% year-to-date. Successfully sold the Clancy Hotel for $115 million in November. Refinanced multiple properties, improving debt maturity profile. Quarterly dividend maintained at 5 cents per share, 7.5% annual yield. The company declared Q4 2025 dividends in October, maintaining the 5 cents quarterly payout, which equates to an annual dividend of 20 cents per share. At the current stock price of $2.65, that represents approximately a 7.5% dividend yield, quite attractive in today's market. The sale process continues to progress, with management indicating they're evaluating multiple options for maximizing shareholder value. Currently trading at $2.65, BHR presents an interesting risk-reward setup for income and value investors. The analyst consensus price target of $4 represents approximately 51% upside, though the rating is hold, reflecting some caution about near-term headwinds. The bull case: if the strategic alternatives process results in a sale of the company or significant asset monetization at attractive valuations, shareholders could see substantial upside. Luxury hotel REITs trade at significant premiums when acquired. Additionally, if operating momentum continues with improving urban demand and group bookings, the stock could reach that $4 to $5 range over the next 12 to 18 months, representing 50% to 90% gains plus the 7.5% dividend yield. Face the bear case. The hotel sector remains challenged with economic uncertainty. San Francisco continues to struggle with high office vacancy affecting their properties there. The company reported a net loss in Q3, and if leisure demand weakens further or corporate travel stalls, profitability could remain elusive. Additionally, the strategic process may not result in attractive offers. There you have it, Braemar Hotels and Resorts, a luxury hotel REIT trading at $2.65 with a 7.5% dividend yield and 51% upside potential to analyst targets. With a strategic sale process underway, improving urban hotel performance, and active asset monetization, this could be an intriguing play for income investors who can stomach some volatility. What do you think? Is the 7.5% dividend enough to make this attractive, or are the hotel sector headwinds too concerning? Would you invest for the yield or wait for clarity on the strategic process? Drop your thoughts in the comments below. If this analysis added value, smash that like button and subscribe to Smart Investing for more dividend and REIT opportunities. Remember, this is educational content, not financial advice. Always do your own research. Thanks for watching.